Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have on Burke Ashenden from Innovator ETFs. We talk about their new 100% downside protection ETFs that are coming out in July. They have a 6-month, a 1-year, and a 2-year. They also have a vast suite of buffer ETFs, which we also get into. And we talk about how to maybe combine some of these to create some really unique outcomes. So without further ado, please enjoy this episode with Mr. Burke Ashenden. Hey, Burke, welcome to the show.
Hey, Brad. Thanks for having me.
So before you get started, why don't you give everybody a bit about your background and how you ended up in the role that you are today with Innovator?
Yeah, thanks so much for having me. I'm excited to be here. My current role is head of capital markets at Innovator ETFs. My background is grounded in ETFs. Started my career on the trading side at Virtu Financial, which is an ETF market making firm in New York. Cut my teeth under some of those traders, learned how ETFs work, learned how to trade them, learned a lot about liquidity. And then from there, came over to the dark side of the ETF issuers. Spent some time at Direction doing the leveraged ETFs with that team over there, great team, and then joined Innovator a little over 3 years ago to start this defined outcome ETF journey.
That's great. And so before we kind of jump into that defined outcome, defined protection suite, I always like to ask people, what do you do when you're not working, not behind the desk? Any hobbies, things you enjoy doing?
Yeah, I made the move from New York City after 8 years out west to California recently. So spending a lot more time outside than I ever did in New York. So I'd say hiking is something we do a lot of out here. Muir Woods isn't too far from us. So we're definitely spending more time outside.
Yeah, I live in Pittsburgh, so I don't envy. I'm sure you are well aware of what the Northeast weather pattern. And so anytime I can get out to the west side of the country, it's always an enjoyable experience.
Oh yeah, it can be brutal. I know it.
So let's talk about Innovator ETFs like as a whole. The firm has a large suite of ETFs. I know they're siloed into kind of some different strategies. But what do you want Innovator to be known for? Like what specifically are you guys really, really good at?
Yeah, so Innovator as a firm launched their first ETF in 2018. So our founders were Bruce Bond and John Southard, the original founders of PowerShares ETFs. So legends in the industry. They sold that business to Invesco. And the great story is one of them was pitched a structured note actually in their pseudo retirement. And the light bulb went off and they said, you know what? This is a gigantic market. It's not necessarily touching advisors. It's more so insurance. And there could be a better way to structure these products in the ETF wrapper. So 2018 launched our first defined outcome ETF. And if there's one thing you have to know about Innovator, this is all we do. Defined outcome ETFs is our singular focus. We pioneered the space in 2018. Competition has come in. You've seen other issuers launch similar buffer products. But when you pick up the phone, you call Innovator, everyone at the firm focuses on this. So we consider ourselves experts. We're passionate about it. That's all we do.
So let's talk about what defined outcome is and also what defined protection products are like as a whole. So how do they differ, and explain to the advisors to really what they're trying to accomplish?
So defined outcome ETFs are kind of the umbrella. You can think about that as like the high level catch-all for these ETFs. And we started with buffers. They were just buffer ETFs. We launched a 15% buffer against the S&P. So really simply in that example, over a 1-year outcome period, that ETF will give you a 0 to negative 15% buffer against losses. And in exchange for that protection, you have a cap on the upside. So we'll call that cap 14%, which is about what it is right now. So no free lunch. We give you that downside protection in exchange for that upside cap. If the market moves below negative 15% over that 1-year outcome period, you're going to take on any losses. So just quick numbers: if the market's down 20 in a 15 buffer, you're going to be down 5. If the market's down 10 and you have a 15 buffer, you're going to be flat. Less expenses, obviously. Same thing on the upside. You're 1-to-1 on the upside with the price return of SPY to that cap. So that's kind of a structured note payoff is where that initiated. You can kind of think of RILAs and that kind of that part of the industry for those types of payoffs. And since then, there have been so many different flavors. So we have different buffer levels. We have different indexes. We started with SPY. We had a 9, 15, 30 buffer. And now we have quarterly outcome periods, resetting every 3 months. We have 2-year outcome periods. But if you had to know the really simple breakdown, it's buffers. And then we're going to talk about today defined protection, which is an extension of buffer, just a 100% buffer, which is sort of a new creation as of the past year.
So your buffers are all quarterly. Are your defined protection, which we're going to talk about today, are they also on the same quarterly cadence, or are they monthlies?
So the outcome periods can be quarterly, they can be annual, and we actually offer different monthly series. So Brad, you'll notice we have a ton of tickers on our website, over 100 ETFs at this point, which is kind of crazy to say out loud. And the reason we did that is we want funds to be resetting every month. So if advisors have money coming in throughout the year, they can get in right at the start of that new outcome period. So for instance, our June series just rolled a couple days ago. So PJUN is our 15 buffer there. That just rolled. So advisors bought in on that day one or around day one, and they can hold that for the entire outcome period and have that protection. If they miss June 1 and they want to come in July, we also have a series resetting at the end of June for July 1st. So we have different monthly series rotating, and the outcome periods are either quarterly or annual.
So how are these ETFs kind of structured internally in terms of the holdings? Is it they're all outcome, or I'm sorry, are they all option packages? I mean, why don't we pick one? Let's pick one of your new issues and kind of whichever one you want, and we'll kind of talk about how internally that is built in order to achieve the objective.
Yeah. So I guess let's talk about the defined protection, since that's what I was hoping to cover today. Those are 100% buffer ETFs. So you can think about them very similarly to the rest of our buffer suite. It's a basket of options is what it is at the end of the day. Flex options are what we use. Flex, you can just think of flexible. You can customize the tenor. You can customize the strike. And that's what gives us that pinpoint accuracy, which is what allows us to deliver a defined outcome. We get questions all the time. Could we just use listed options? Why do we have to use flex? Could we just use whatever is available on screens? We certainly could, but we wouldn't have that precise nature of the defined outcome. I could get you a 14.5 buffer and a 12.25 cap, but we want to deliver that exact buffer that we state. So that's why we use flex options. Peeling back just how it works, we use for the 100% buffer ETFs, it's 3 options in the basket. So we have a deep in the money call, which gives us that 1-to-1 SPY exposure to the upside. Then we have our protection. So we buy an at the money put, and that gives us that full protection. Now, like I said before, there's no free lunch with this ETF, so we have to finance that protection somehow. So that's the third option leg. We're going to sell a call at the highest level that we can to finance that protection. And wherever we strike that call, that's the cap on the ETF.
So let's talk about kind of like a 1-year defined protection of 100%. So you just released that June series of that one. Do I have that correct?
They're actually coming in July.
July.
So 3 coming, but we already have a couple out there that were launched last July that were 2-year outcome periods. Now we're taking them annual in 6 months.
Okay, so for an annual, what on the July? I don't know if you have the exact outcome period yet in terms of the cap, but roughly, let's say that cap is somewhere in the 8 to 9%. Is that fair?
That's right. It's actually pricing above 9% right now.
Okay, great. So, but it's not a 1-to-1. So if I'm an advisor buying this product and I am looking to cap the S&P exposure at 9% with 100% downside protection, and the market moves up 9% in the first month in January, right? I'm not going to actually make 9% in the ETF. That NAV is not going to move up 9%. And that's because of the decay of the time value of the option. Is that correct?
That's exactly right. You can expect a lag intra-period. So the defined outcome is realized at the end of the outcome period. So if you hold that until the end of the 1 year, that defined outcome will be realized on the last day of the outcome period at the close. Now, what's people don't always think about this with these types of ETFs, but you have a defined outcome at any point during the outcome period when you buy, if you hold until the end. So in that example you gave, a client could also buy in halfway through that 1 year outcome period at the 6 month mark if they like that payoff, and they could hold it until the end of the outcome period and still have a defined outcome. It would just look different than it was on day one.
And you actually took one of my questions there. So is there a way, if I'm thinking through this, is there a way to kind of generate additional alpha, maybe over the cap, if the market starts the year highly negative, or is the cap the cap?
The cap is the cap, but if the market does move down negatively, you're just going to have more cap. So it has that stated cap on the first day of the outcome period. But in that example you gave, if the market starts the outcome period down 5% in the first week or two, you get a sharp drawdown. The ETF may trade down slightly. It's not going to trade down 1-to-1, and you may have some additional upside cap.
So you have three full downside protection ETFs, 6 month, 1 year, and 2 year that are launching in July. Can you talk about maybe how advisors look at them differently and maybe how they're using them? Because I can see using a 6 month a little bit differently than the 2 year. So how do you guys at Innovator define kind of best practice of using these three different outcome periods?
Yeah. So we were trying to solve for a couple different problems when we launched these ETFs. Like I mentioned before, structured note world we kind of use as our North Star when we're thinking about new products. And if you look at that space, it's been booming, frankly, over the past few years. 2023 was a record year for structured note issuance, over $100 billion. And principally protected notes were a humongous portion of that. In fact, that's one of the biggest growth areas of the past 2 years. So people love that idea of principal protection for their investment. And you can think about FIAs, you can think about annuities. Those spaces have been growing significantly as well over the past 2 years. So principally protected structures is what we were trying to target with this. And we were solving a couple problems. The first is cash on the sidelines. We talk to a lot of advisors, and they tell us that around 30% of the portfolio right now is in cash-like or cash ETFs. In our view, that's just too high. You're getting attractive yields right now, 5%. Difficult to argue with a 5% treasury, but we talk about taxes. Taxes are really important too. And you're getting charged ordinary income on that. So that 5% yield becomes 3%. And people don't always think about that. So from our view, we're trying to help advisors get cash off the sidelines. And these types of strategies are able to equitize cash with a full downside buffer. So no principal risk, but you can tie that money to the equity markets. Second thing too is all-time highs. I was just talking to a colleague about this, and we've hit 24 new all-time highs in 2024, which is an astounding number. Market's off to a rocket start this year, up about 12% so far year to date. And last year, I believe we were around 26%. So we've had it really good, no doubt, over the past 2 years. We haven't had a 2% down day in over 300 days. I'm just going to keep throwing stats at you. The market is over its skis. And I think people are a little concerned. The advisors we talk to are concerned about investing at all-time highs in equities. So this is a perfect solution for those very conservative clients, those retirees, those pre-retirees, to equitize that cash.
So if I'm a model portfolio provider and I'm looking to create risk managed portfolios, let's say something off of a 70-30, a 60-40, or even let's call it a 30-70. And my clients are in the growth stage of their life. They don't need the income. Could there be an argument that you could utilize some of these as a fixed income and kind of volatility dampener in an overall portfolio rather than having to kind of rely on the fixed income markets to reduce some standard deviation volatility out of the portfolio?
Most definitely. The use cases are numerous. It could be a conservative equity allocation with a 9% cap on the S&P over 1 year. That's above the average S&P return when you look historically. So that right there in and of itself could be a conservative equity allocation. Bonds, we are definitely seeing it used as a short-term fixed income alternative. Like I said before, you're getting a decent yield right now at a fixed income. I won't deny that, but taxes matter. So to your point, if someone's going to hold this in perpetuity, the cool thing about these ETFs is they reset within the structure. So every year or every 6 months or every 2 years, depending on what ETF you buy, it's going to roll within the ETF wrapper. and there's no taxable event. You're going to get a fresh downside buffer. You're going to get a fresh upside cap, and we don't expect any distributions. And you get to choose as the investor when you sell. And if it's over 1 year, you're paying long-term capital gains, 20%.
So when looking through the entire suite, you've got various different buffers. You've got 100% downside protection ETFs over multiple different periods. I'm sure you can create, and I'm sure internally you guys have talked about this, some really cool portfolios that have kind of broader defined outcomes by combining some of these in an asset allocation. Can you talk about that at all, or is that discussion? I saw briefly, and I didn't do enough due diligence. I hope you can talk through it. Some model portfolios you guys have that are on the site, but I'm sure there's a way to combine some of these different products to create something pretty cool.
Yeah. I mean, no doubt that's where the puck is going, I think, across the industry, model portfolios. It's just simple for advisors to implement. So we launched our own off-the-shelf model portfolios on our website just because advisors kept asking for some sort of direction around how they can implement this in a model. So if you go to Innovator Research, we actually have model portfolios on the website, and we help advisors think about how they can implement these within that model allocation. To your point, I mean, you could put the 6-month with the 2-year, and you get some pretty interesting risk return characteristics. Or you could pair the 100% buffer with a 15% buffer to allow you to have a little bit more upside than just if you were in our principally protected defined protection ETFs. So there's all sorts of different flavors, and we really try to simplify it at Innovator. Like I said, we have over 100 ETFs, but we really think about it simply. It's buffers. So if you come to us, we can help you with that implementation.
So I know that there's a billion different use cases for these, which makes them unique. I think they're great products. If you're sitting down with an advisor, though, with an already, kind of static standard model portfolio, they've got their large cap equity bucket, they've got some fixed income in there, maybe they're holding some alts, like where are you advising them kind of first to start implementing a full 100% downside protection? I would assume that's in the cash bucket. I think that is your first, but kind of when you're talking to advisors that have already created a diversified model portfolio, like what products are you trying to lead with and where would you put them?
So right now we're definitely leading with the 100% buffer ETFs. The 15% buffer, we call it our power buffer, is sort of our bread and butter. If people are going to try their first buffer ETF, that's generally the most popular. It's kind of that sweet spot where it could be hedged equity and also just a core equity allocation. For the defined protection ETFs, which is what we've been talking about, it doesn't make a difference if you put a 5% or a 3% allocation in the portfolio. You need to have a meaningful allocation to this for it to actually make a difference. So we would say 20% of the portfolio, maybe even 30%, pulling from that alts, that fixed income, and that cash. Advisors, it was really interesting when we go back to COVID and rates came all the way down. Our buffer ETFs kind of took on a new life. They flipped, and people started to actually use their buffers almost exclusively as a fixed income alternative because of where rates were at the time. They needed more upside. They juiced their bonds for everything that they could. So they used buffers as a solution there. So we're starting to see that continue despite the higher rates. The caps that we have right now in these products are really compelling. A 9% cap over 1 year has definitely garnered a lot of attention in the marketplace.
So what would the difference between a 1 year and a 2 year 100% of, or is there an advantage of using a 2 over a 1? Why not just let the 1 year roll over and having that flexibility at the roll period to be able to kind of either find something else or generate a new cap? Like what would compel someone to use a 2 instead of just rolling a 1 twice?
It's a really, really good question. And we got it a lot because we launched the 2 year first. And folks asked, why didn't you do the 6-month? Why didn't you do the 1 year? So a couple reasons. The first is think about how markets work, right? So your frequency of getting capped out is going to be higher potentially with a shorter outcome period. So with the 2 year, if the market skyrockets 15% in 1 year, and then it has a lower return the following year, a 3% return, you're going to get to capture all of that upside in the 2 year product. Versus, let's say the market, I'll pause. How often does the market actually return the average, right? Very rarely.
Almost never.
Never,
yeah.
right? So the market kind of goes like this. So we wanted to deliver a product that might have more staying power for those kind of sideways choppy markets, which is why we started with the 2 year. The 1 year outcome period at a 9% return is equally compelling. And that's for folks that might have a shorter outcome period. They might have a shorter time horizon. And the 6-month is just pricing really well right now. That's JJL is the ticker on that one. And it's pricing around a 4.8 to 5% cap. And that is extremely compelling for somebody that is looking for a true cash alternative.
No, I asked this question earlier, but just for my knowledge, if it's a 2-year outcome period, and as in your example, the market skyrockets in year one, say 15%, maybe you're only going to capture 7% of that upside. You can prove me wrong. This is just the way my head's working. But if the next year it's up, only 3%, you're going to continue to earn incremental NAV up to that cap or close to that cap in year two. So you might only get 30 to 50% of the actual return of year one. Am I thinking about that correctly?
You're right. There will definitely be lag. You're not going to move 1-to-1 with the ETF during the outcome period. But I mean, if you think about it, what if the market does nothing for the next year? It just stays flat. Well, then you're just going to see that ETF's NAV appreciate up to that cap.
Yep.
So it's just different flavors for different folks. And at Innovator, we just want to give you the broadest set of solutions.
Yeah, no, I love that because I'm thinking of a situation where, if I'm a tactical active advisor and I think I have a pretty flattish view of what the market is going to do that year, and you have a 2-year defined outcome that's got some growing to do, it makes sense to add it because that if the market does nothing that year, there's going to be some alpha there. So it's interesting. I find these products extremely interesting, how they work. Can you just go through the 6 month, the 1 year, and the 2-year July issues, what those tickers are and what the current caps are that you're expecting in those products for July 1?
Yes. JAJL is the 6-month product, and that's pricing a near 5% cap right now. ZJUL is the 1-year ticker, and that's pricing a high 9s, close to 10% cap. And then AJUL is the 2-year ticker, and that's pricing around an 18 to 19% cap. So those are the 3 funds launching. Too, I'll just add, Brad, that with these types of ETFs, we talked about the structured note side of things. We surveyed advisors, and the big things that they value are liquidity, simplicity, and cost. So the ETF just wins on all of those fronts relative to some of those legacy solutions.
Yeah, I was actually staying on that topic, was having this conversation with a friend of mine and said the structured note business, even though it boomed last year, is going to be completely taken over by these things. The liquidity's in the cost is just way too attractive, as well as the flexibility not to utilize these rather than kind of an old-fashioned insurance-based structured note product.
Yeah, I mean, when you think about some of the headaches that come with those products, phantom income is one that just drives people crazy. You're going to get hit with that intra-outcome period with some of those structured products. If you want to sell out, you're probably going to cross a gargantuan spread if you can even get out at all in the structured product. So we talked about that lag earlier, intra-period with the ETFs. Sure, it's going to lag on the upside if you want to exit before the end of the outcome period, but having that escape hatch for advisors is also really valuable.
Well, Burke, I really appreciate your time. Before I let you go, is there anything else you want to discuss regarding Innovator, any of these ETFs? Again, you guys have a huge lineup, and so I want to make sure I give you the opportunity, if there's anything cool you guys are working on, to share it with us now.
Yeah, Brad. I mean, thank you so much for the time today. I would just say that, when you think about defined outcome ETFs and you look at our broad suite, yes, it is a lot of ETFs, but the concepts are really simple. They're just different monthly series, different flavors of the same product. So I would encourage advisors or whoever's listening to this call to go to our website and look at our tools. We have spent a lot of time creating these tools to help simplify things for advisors. We have a potential outcome analyzer tool that lets you see your outcomes based on that specific point at which you buy. We have previous outcome analyzer tool, which lets you look back at older outcome periods. So the tools are there. We have a sales team in each territory that can help answer those questions. And like I said, this is all we do. So we're proud of it.
Well, again, before I let you go, where can people actually get that information? So can you give them kind of your website or any other research-based websites you guys have?
Yes. I would point them to innovatoretfs.com.
All right. Well, again, Burke, thank you so much for your time. I appreciate you being with us today.
Thanks so much, Brad.